Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a strategy that we've been using a lot over the last month, which is credit vertical spreads. This is a strategy that is very versatile. It can be used in a lot of different market environments, but predominantly when you have more of a neutral or mild view on a specific security in terms of a bullish or bearish view. So today what we're going to do is we're going to break down the strategy. We're going to talk about, number one, when should you use it? Because it's very important that we first understand when you want to use credit spreads. It's not a strategy that you just want to use anytime you have a directional view. So we want to be very clear as to when you want to utilize it. And then we'll talk about how to set up the optimal credit spread for your directional views. And then lastly, what I want to do is I want to show you some examples of trades that we're looking at, as well as some of the things that we're working on to help you identify the credit spreads that provide you with the most edge from an options trading perspective. So a lot to unpack here today. Let's go ahead and get started. Before I do, just a quick disclaimer. What we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's go ahead and get started. Now, for those of you that are first-time viewers of OptionsPlay, today what I'll be doing is I'll spend a few minutes looking at the slides, but I'll jump back and forth between the slides and the OptionsPlay tool, which is the tool that you have access to as either as a member, but if you're a first-time viewer of OptionsPlay, you can sign up for a free trial using the link here on your screen, which I will post into the chat window. And it's a good time right now to bring up your chat window for those of you so that you can participate during the event here today. So you can find your chat window at the bottom of your screen. So signing up for the free trial gives you access to the daily trade ideas, the weekly market outlook sessions. I'll talk a little bit about that later today, as well as the options education webinars like the one we are on right now, so that you have access to the education as well as the recordings afterwards, so that you can learn how to trade options through the different educational sessions that we have, as well as a free 6-step options trading course to help you get started if you're brand new to options trading. So a lot of things that are given to you for free as part of your free trial. So if you're a first-time viewer of OptionsPlay, welcome, and I hope that you guys enjoyed that free trial. So let's go ahead and get started here. Number one, I want to start by talking about when should you use credit spreads, because it's so important. I would argue that this is more important than understanding what are the optimal credit spreads, because I many times see users use credit spreads in the wrong environment, where you're really risking your more capital than you really need to by selling a credit spread instead of using other strategies like buying a debit spread or buying a call or put. So today what we're going to do is we're going to break down those two examples so that you really understand when you should be selling options such as a credit spread, and more importantly, when should you be buying options. And knowing the difference between the two is very important, because that's really how we can make sure that you're utilizing your capital as efficiently as possible. Once we understand that, then we'll talk a little bit about what are the optimal credit spreads, meaning how do you select expiration dates, how do you select strike prices, how do you understand how credit spreads are structured. Especially for those of you who are brand new, it's important to learn that. And then what we'll do is we'll go through how to manage them, meaning once you're in a credit spread, how do you decide when to take profit? When should you cut your losses? And then we have a few examples with some real symbols so that you can take a look at some bullish and bearish examples of what we consider the optimal credit spreads, the type of spreads that we've been selling predominantly over the last month as the markets have been fairly volatile, but hasn't had a strong directional view. So very important topic for us to continue taking a look at. So today, first, we want to talk about when are credit spreads used. First and foremost, credit spreads are used for three primary reasons. Number one, when you are near a support or resistance level. So think about this as sort of a market top. So whenever you are near a market top, when you're near a market bottom, these are ideal conditions to sell credit spreads. Now, you can sell a bull put spread when you have a bullish view. You can sell a call credit spread when you have a bearish view, and you can do this over and over again. And you can do this whenever you feel that the markets are in a range bound market they're overbought or oversold. You can use technical indicators for this. You can use RSI, MACD, stochastics, any of these types of technical indicators that provide you with oversold and overbought conditions. They can be utilized in these types of market conditions. So the chart that I have here is SPY. It's a 4-hour chart over the last month. This is a chart that we've been going over very heavily, as for those of you that have joined us on Tuesdays and Friday mornings. And we've been talking about how the market has been fairly range bound and basically trading around this equilibrium, this 285 level. As you can see, we've been at 285 since basically early April, and we've been trading just back and forth, slightly above it, slightly below it, slightly above it, slightly below it. These are ideal conditions to be selling credit spreads because you don't have a strong directional view. Markets are fairly range bound. It's not really moving a whole lot. And especially when volatility is high, these are the conditions to be selling credit spreads. So it's important that you understand that those are the only conditions you want to sell credit spreads. Now, conversely, if you expect the stock to break out, right, and we're starting to see this a little bit to the upside, right? We've been 290, 293, 292 has been a major resistance level for quite a few weeks now on SPY. We've just broken above it. So if you think the markets are now going to rally significantly, then it might be time to start buying calls instead of selling put spreads. This is something that we discuss on our Friday morning session. So we'll talk about that in depth a little bit more tomorrow morning. I hope that you'll be able to join us. But the key here is that credit spreads are only useful when you're expecting a small directional move. If you're expecting a big move, there are other strategies that are far better that actually risk less money. Credit spreads actually risk a fair amount of capital, which is why you shouldn't just use them all the time, and you certainly shouldn't use credit spreads. You know, I tend to see a lot of users who gravitate towards selling credit spreads, people who sell credit spreads all the time, no matter what. And it's really important that you don't necessarily do that, that you focus on selling credit spreads only when the environment is correct. Now, I also see a lot of people will say that, you know, generally speaking, you want to sell credit spreads in a higher volatility environment. Now, generally speaking, this is true, but there are many cases where when volatility is not high, you still want to sell credit spreads. So I want to make sure everyone understands this before you simply just sell credit spreads when vol is high and buy credit spreads when vol is low. Now, just before I move on, how many of you have heard selling vol when it's high and buy vol when it's low? Please type 1 into the chat window if you've learned that from somewhere, whether it's another trading tool or signal provider. Yes, so you see a lot of ones, right? So people will say that it's time to sell vol when IV rank or IV percentile is high, and then buy vol when IV rank is low. Now, generally speaking, that is true. But today what I want to do is I want to show you some examples where that's not true all the time. And there's plenty of examples where you can find really great credit spreads even when vol is really low. So this statement, while true as a general statement, not true all the time. So be careful when you use that as your primary decider as to whether you're going to buy or sell volatility. So first example, what I'm going to do is I'm going to use an example like Johnson & Johnson. I'm using Johnson & Johnson because this stock, as bullish as it was after the initial rally from the March 15th lows, really has been pretty much range bound for quite a few weeks, and it's really been range bound within a pretty tight range here, around 146 or so to the bottom and around 150, 151 to the upside. So you're trading about a $5 to $6 range. Every time it reaches the top, it kind of sells off. Every time it reaches the bottom, it rallies, and we're kind of near the bottom of the range here. So what I'm expecting here is that Johnson & Johnson is going to rally back towards the top of that range. So I want to show you some strategies as to how to go about playing that. Now, generally speaking, when you have a bullish view on a stock, the first strategy that you tend to gravitate towards as an options trader is buying a call option because it's a simple bullish strategy. So what we're going to do here is we're going to compare buying a call option here to selling a put option, which also is technically a bullish strategy. Now, for those of you that joined us for our beginners options master course, where we talked about the benefit of options and we talked about the difference between buying and selling options, we discussed that buying a call it's not fair to call it bullish. It's actually bullish by a certain amount because you're paying for that premium. You have to overcome that premium before you can make money on that trade. Vice versa, when you sell a put, it's not exactly bullish either. It's mildly bullish, but not too much. So today we're really going to look at the difference between the two and talk about the difference, and then from a more practical perspective, and then talk about how you can improve it by using a credit spread as opposed to just a single leg option. So first, for those of you that are brand new to options trading, you know that a call option is bullish. So what we're going to take a look at is Johnson & Johnson is currently trading at 146. And we think that Johnson & Johnson is going to go higher. We think it's going to go back to the top of that range. So the first option strategy that you learn is you can buy a call option here. Let's say this June 146 call costs $3.70. I'm going to round it down to $3.50 for an easy example, which means that I have a break-even price of 149.50. Now, as I said, this range isn't very wide. It's about 146 to 150, 151. So if my break-even price is 149.50, is that something I really want to do? You might, but keep in mind that as far as how far I think Johnson & Johnson stock can go, it's fairly limited. And this is really an example where even though a call option is bullish, I may not want to buy that call option simply because I don't think Johnson & Johnson is going to rally 10, 15 bucks in the next month or so. This is the June 19th expiration, which is only 30 days away, not very far. So in this particular case, yes, a call option makes sense because I can risk only $3.50, which is roughly 2-3% of the underlying stock price to bet that Johnson & Johnson is going to go higher, and I have unlimited potential reward. So if Johnson & Johnson tomorrow has some news that they've discovered a vaccine for COVID-19 and the stock rallies 50 bucks, I'm able to participate that while risking only $3.50. Now, that very well may be what you believe, but in this particular example, what I'm trying to do is say that not every stock that you have a bullish view on, are you that bullish? You might just be mildly bullish. Maybe you just think that 146 is a support level. I don't think it's going to go much higher. I don't think it's going to go much lower. That's really where a call option is not the best trade for you to make. Conversely, what you can do is sell a put option here. So here, what I'm going to do is I'm going to sell the same 146 put option here instead of buying the call option. As you can see, the 146 put collects roughly $3.90. I'm going to use $4 as a nice round number here. And this break-even price here is 142, meaning as long as Johnson & Johnson stays above 142, which is roughly down here. So I think Johnson & Johnson is going to go higher, but if it goes sideways, or even if it moves a little lower, guess what? When you sell a put option, it's very forgiving, meaning, yes, you make money if the stock goes higher. Yes, you make money if the stock goes sideways, but even if the stock goes against you, you can still make some money because as long as it stays above 142, you'll make money. The only time you lose money on this trade is if the stock drops below 142. Does that make sense, everyone? Please type 2 into the chat window if this makes sense. The difference between buying a call option and selling a put option. Because a call option, you have to have a significant rally before you make money. When you sell a put option, you don't have to have a significant rally. You can have the stock move sideways. You can have the stock move a little bit higher. You can even have the stock move a little bit lower and still make money. The downside here with a short put is the fact that you have unlimited risk to the downside, right? When I buy a call option, my risk is only $3.50 no matter what. When I sell a put option, I have unlimited risk, meaning if the stock goes to zero, I'm losing $146, well, really $142 in exchange for what? Just $4 of income. And that many times for most people is difficult to swallow, right? Risking $142 to make $4. The thing I will say is that that's not really a fair comparison because that's assuming that Johnson & Johnson stock goes to zero by June. And chances of that happening, fairly low. Even if the stock drops to 120, which is a fairly extreme example, you're still only looking at roughly $40 worth of risk for the $4 in income. Not great, but still something that you can accept. So this is really the two options that you have. Now, what we're exploring right now is when we have a mildly bullish view, meaning we think Johnson & Johnson stock is going to make a little move to the upside, that's for that particular case, what we want to do is we want to sell a put. Now, the challenge with selling a put is the fact that you have unlimited risk. And that's the reason why we're even here, because we want to learn how can we take on this type of risk profile where if the stock moves a little higher, I'm able to profit, but still give me a little buffer to the downside. But I want to do it without taking on unlimited risk. No one wants to take on that type of unlimited risk. And that's really where we come to credit spread. So a credit spread is really taking your short put and improving it a little so that you don't have to take on unlimited risk. The same way a debit spread is really improving buying the call option a little bit by reducing the risk on that trade, reducing the break-even price, improving your probability of profit. A credit spread is really just improving the opposite of that, which is selling a put option. So let's go ahead and see how that works. So here, what I'm going to do is the exact same trade. I'm going to sell the 146 put for the $4 that I just showed you. But like we said, when we sell that that 146 put for $4, I have unlimited risk, and most people aren't comfortable doing that. So what can I do? How a credit spread works is what I do is I buy a lower put against it. So when I buy a lower put, and in this particular case, let's say I buy a 140 put, and let's say that cost me $1.50 to buy. What that means is that originally I received a $4 credit. But because now it cost me $1.50 to buy that 140 put, my net credit reduces down to $2.50. But when I buy the 140 put, what happens is I cannot lose any more money below 140. So before, I said that my break even is around 142. And if the stock drops below 142, I lose money. If it drops further, I lose more and more money. What I'm doing here is I'm basically taking on the same risk profile, but I'm capping my risk so that no matter what happens, even if the stock goes below that, I will never lose more money than if the stock reaches 140 or lower. So any point at 140 or lower, I will not lose any more money. Does that make sense? That's the reason why we sell credit spreads. It's not really to sell a credit spread. It's really to sell a put, but do so in a way so that we don't have unlimited risk. So if that makes sense, everyone, please type 3 into the chat window. So credit spreads, not too difficult to understand once you understand selling a put option. It's really just a way to protect yourself from selling that put option and taking on unlimited risk. Now, here are a few things that are really important for you to learn when you're selling credit spreads. Number one, there's a thing called the vertical width. The vertical width is very simple. It's just simply the distance between the two strikes. So if you have a 140 strike and a 146 strike, what's the distance between that? It's $6. So whenever we're talking about vertical spreads, the width is really what you're playing with. So the width is the most amount of money you can make or lose on any type of vertical spread, whether you're trading a debit spread or a credit spread. The difference is that whatever you receive in terms of credit on a credit spread, the rest of that width is going to be your risk. So in this particular case, I'm collecting $2.50. That's my max reward on a credit spread. No matter what happens, even if Johnson & Johnson goes to $1,000, I'm only going to make $2.50. On the flip side, my max risk now is, instead of being unlimited, is now only $3.50, which is the difference between $6 and $2.50. So my max risk is always going to be the difference between the vertical width and the premium that I receive. So it's important that you think about vertical spreads as the width, because the width is really kind of what you're playing with, and then the income that you're receiving is what you're really looking for. We're going to look at this in a few minutes, but it's important to remember this concept, because the more income that you receive, the less risk you have. So what you're really trying to do when you're selling a credit spread is maximize this number so that you can minimize that number. So if you, again, just to clarify, if you maximize this number, what you do is you minimize that number, because this number is fixed. $6 wide is fixed. So if you can sell the $6 wide credit spread for $3 instead of $2.50, now not only have you increased your potential reward, you've also decreased your max risk on the trade. So whenever you're thinking about a credit spread, what you're really trying to do is maximize the credit for the width of the vertical spread. Does that make sense, everyone? Please type 4 into the chat window if that makes sense. And we're going to show you a little bit in a few minutes as to how you can potentially try to seek that. Okay, so great. I want to make sure everyone understands this. So I spent a lot of time going through these examples because I think it's really important to understand these before you move on and think about selling credit spreads. If you're brand new to selling credit spreads, I hope that this helps you understand why you want to consider selling credit spreads. And if you have sold credit spreads, I hope that this makes you understand a little bit more as far as why it's so important to try to find that edge, because the width is fixed and you're trying to capture the maximum amount of that width whenever you're selling a credit spread. So let's now take a look at a bearish trade. Now, everything's going to be exactly the same as before, but just flipped on a dime here. So let's say we're looking at SPY. This goes back to the first chart that I showed you here. SPY has really been trading within this kind of pretty tight range around this 285 level. And every time it reaches the top, it kind of pulls back a little. Maybe you think that that's going to happen again here. Maybe it'll pull back to around 285 or so. It's trading around 295. So naturally, as a first-time options trader, and you think that a stock's going to move lower like SPY, what do? You buy a put option. That's a simple option strategy to allow you to take a bearish view. So let's take a look at a June 295 put trading at about $8.65 here. So here I actually should have updated this. This should be $8.50, not $9.50. So I will make sure that we update this before we send this out. So my break-even price here is around 286.50. So my break-even price is 286.50. Now, if I only think SPY is going to pull back to 285, then a break-even price of 286.50 means I'm barely at break-even, even if SPY pulls back to the level that I expect. And that is the biggest challenge that you have with buying options, is the fact that you're not just taking on a bearish view, you're taking on a bearish view by a certain amount. And that certain amount depends on how expensive the put options are. So in this particular case, not particularly cheap. It costs you almost $8.50 to buy a put option, and you only think the stock's going to make a $10 move. Not a great trade to make, right? Because even if the stock makes the expected move, you're looking at $1.50 in potential reward while you're risking $8.50. That is not the type of risk reward that you generally want to take. But the benefit of buying a put option is the fact that you have limited risk no matter what happens. Even if you're wrong and SPY really rockets higher, right? Not anything is possible these days. If SPY really rockets higher, no matter what happens, you're only risking that $8.50. So unfortunately, I have to update this spreadsheet. But your max reward is unlimited, meaning if SPY really tanks, right? And we just got some news that there's some tensions in Hong Kong. God knows what can happen. We could get a second wave of COVID and markets really sell off. You're able to take advantage of that unlimited view. Now, that may be the case in this particular trade, but there are plenty of other trades where you may have a mildly bearish view, but you don't think the stock's going to fall out from under, and you just want to take a short-term bearish view. So that's really where we can then turn to selling call options instead of buying put options. So when you sell a call option here, I'm going to sell the 295 call. Let's say in this particular case, this collects about $8.50. I'm going to round it up to $8.50. What that means now, my break-even price is 302.50. So the stock's at 295. I think the stock's going to drop. But what if the stock stays sideways? I'm still going to make $8.50. I actually continue to make money as long as the stock stays below 302, which is this red line up top. For those of you that have been following us on Friday mornings, we've been talking about 300 and 302 as a major resistance level for months on end, well before the COVID-19 sell-off. So it's really important for us to remember that even if the stock goes a little higher, we can still make money, even though we've gotten the direction wrong. And that's the forgiving part about selling strategies. The flip side, the downside to selling strategies, is the fact that you have unlimited risk. Now, this basically means that the stock goes to infinity, which chances are between now and June, SPY is probably not going to go to 350, 400, right? But it's just important to understand what type of risk are you taking when you're selling a call option. So a call option really allows you to profit if SPY stays sideways, if it moves lower. But the only downside is that if the stock really plummets, right? If the markets really plummets, the max reward here is limited to just $8.50. You would have been better off buying that put option if you really think the stock's going to make a big move. Now, in this particular case, we don't particularly think the stock's going to make a big move. We don't want to be necessarily shorting the market going into with the Fed buying. So it's really important that we continue to take a look at these types of strategies for trading. And I think Percy made a very good point. He made a very good point that this should be actually 303.50. So again, my math has been really terrible today, and I apologize for this, and I will update these, but it's 303.50 because 295 plus $8.50 is 303.50. So my break-even price is actually $1 higher than I originally put on the spreadsheet. So you have a lot of wiggle room when you're selling a call option to be actually wrong on the direction and still make money. But it only makes sense if you think the stock's going to stay stable or move a little bit lower. Because if you really think the stock's going to make a big move lower, you're better off buying that put option. So it's important that we understand when we want to sell options and when we want to buy options, because when we expect that big move, buy that option. If we expect a more neutral move, sell that option. So just like the previous example with Johnson & Johnson, selling a call option has unlimited risk. We don't want to take on that type of risk. So what can we do? Well, we can still sell the 295 call for $8.50. But what we're doing against that is we're buying a 307 call against that and paying $2.50 for that. We're buying a higher put option to offset any potential losses above 307. So if SPY rallies significantly higher, let's say it reaches that 339 all-time high, well, guess what? No matter what happens, if it keeps going higher and higher above 307, you can't lose any more money, because what you lose on the short call, you're going to gain back on the long call. So that's why when you trade a vertical spread, you have limited risk. Now, here, because I've sold the original call for $8.50, but I bought the 307 call for $2.50. Now, instead of collecting a credit of $8.50, now I'm only collecting a credit of $6. Now, the 295 307 call spread has a width of $12. Again, the distance between the two strikes is the total amount of capital that you're playing with. So what you're trying to do is you're trying to maximize the percentage that you're collecting of that width. In this particular case, I'm collecting $6. So my max reward is $6. And the rest of it, the other $6, is my max risk, $6 in this particular case. I will tell you, this is very, very rare where you're able to collect a credit for half of the width of the premium. And the reason in this particular case are twofold. Number one, you have fairly elevated at the money implied volatility, so you're collecting a higher than normal premium for that 295 call. And then the 307 calls are significantly cheaper than normally. Partially, this might be because the market is not anticipating the markets to move that high, so no one's buying these call options. They're relatively cheap. So to buy that 307 call, it's actually really cheap. So you're paying only $2.50, and you're doing this for $6. Now, this is a trade that I just pulled an hour before this event, and these are the June expirations, and you can go take a look at them yourselves. We're actually going to take a look at these together. So let's just look at OptionsPlay real quick to show you these two examples real quick. So Johnson & Johnson, before I was talking about buying the June 146 calls, which cost about $3.50. And what I'm going to compare that with is selling that put. I'm going to do the same thing, the June 146 put. So here I have to pay $3.65 to buy the call option. Here I'm collecting $4 to sell the put. These are the same prices that we were looking at roughly before. And as you can see, if Johnson & Johnson stays around 146, if I sold the put, I make $400. If I bought the call, I lose $300. Again, because when I buy a call, I don't make any money if the stock doesn't move. I actually have to make, the stock actually has to move quite a bit before I start making money. And even if the stock rallies from 146 to 150, I only make $118 profit versus here I still make $400. So what you can do is you can actually use the slider to see where one strategy starts to outperform. As you can see, the stock has to go to almost 154 before the call option makes sense more than selling the put option. And you can ask yourself, do I think Johnson & Johnson's going to go back up to 154? Because that's the bare minimum for the call option to make sense. You actually have to have the stock move beyond 154 for you to know that buying the call option is the better strategy than selling the put option. If you think the stock's going to be somewhere in between 146, 150, you're far better off selling that put versus buying that call option. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. And the reason that we're now looking at a credit spread is we're basically selling this put, and then what we're going to do is we're going to buy back a lower put against it, so that instead of collecting $4 in premium, here we're only collecting $2 in premium because we want to make sure that we have limited risk. In this particular case, when I buy that 146, when I sell the 146 put, I collect $4.10. I pay $1.96 for the 140 puts. So my $6 wide credit spread, I'm collecting $2.14. So the rest of it, the $3.86, that's my max risk. Okay, so that's how you utilize this. That's how you think about selling a credit spread. Is you're first thinking about selling that put option, and then you're buying back that lower put to offset that risk. Same thing with SPY. If we look at SPY, you're going to see the same thing. So SPY is trading around 294 right now, right around that 295 mark. So again, if you're bearish on SPY and you think it's going to maybe move back down to about 285 or so, which is that equilibrium level that we've been talking about for a few weeks, you can buy, let's say, a June 295 put, cost you $9.47, almost $10, or you can sell that call option. Same June 295 call option. This will give you $7.67. So not as much buffer, but a little, but as much as it costs for the put option. But as you can see, if the stock stays around 294, here you make $767. Here you lose 935. So if you think that SPY is going to move a little bit lower, that's why it doesn't make sense to buy that put option. You're far better off selling that call option. So this is the type of environment when you want to consider selling a call option as opposed to buying that put. But again, selling that call option has unlimited risk. You generally don't want to take on that type of risk, which is why we're going to add a leg to it and buy, let's say, a 307 call against that. Now, as you can see, my $12 wide credit spread, 295, 307 is $12 wide credit spread. I'm going to collect $5.32. So in the Johnson & Johnson example, I collected $2.15 roughly out of a $6 wide credit spread, which is roughly 35% of the width of the credit spread. Here in SPY, I'm collecting $532 out of a $12 wide credit spread, which is 44% of the of the width of the credit spread. So which one is better? Guess what? SPY, from a pure math and probabilities perspective, is a better trade. Now, just because you have a credit spread with really high income does not necessarily mean you should take it, because if you don't have a bearish view on SPY, you should not be selling a call credit spread. So just keep in mind that you want to search for credit spreads that have high amount of income for the risk that you're taking, but you also have to think about the directional view. So in this particular case, this happens to line up fairly well with my directional view that you might get a small pullback here in SPY, but that doesn't always happen. And many times you will find that call credit spreads will collect a little bit more income than put credit spreads. But here's an example of one where the SPY1 collects 44% of the width, which means that you're only risking about 55% of the width, versus before when you're taking on a 35% income, you're risking 65%. So every percentage point you can skew yourself in terms of getting more income, you're also reducing your risk. And that's how you can gain an edge when you're selling credit spreads. So this is just a quick example of some of the things that you should look out for when you're selling a credit spread. So as we said, credit spreads are limited risk to reward strategies with relatively high probability of profit. They're forgiving strategies, meaning even if the trade goes a little bit against you, you can still make money on the trade. Unlike buying a put option, not only do you have to get the direction correct, you have to get the direction and quite a bit correct, meaning if this trade goes against you, you are definitely going to lose money. On a credit spread, that's not always true. And that's why I think a lot of people like to sell credit spreads, but it's important to understand that credit spreads do have higher probability of profit, but the flip side is that you're risking more money than you are collecting. And those two equations balance each other out. Don't just look for high probability. That's one of the things that we're going to explore here. So just to reiterate everything we spoke about here today, it's a relatively forgiving strategy, but it's only used for when you have a neutral or small directional move, because if you do expect a big directional move, you're better off buying the call, buying that put, because you're risking less money and you get to make unlimited rewards if you do get that big move in that particular direction. You generally want to time these with overbought or oversold conditions. Any type of technical indicator like RSI, MACD, stochastics, these are all suitable indicators to help you understand overbought and oversold conditions. You generally want to you want to sell a put credit spread when things are oversold, and you want to sell a call credit spread when things are overbought. Reversals, also tops and bottom formations, double tops, double bottoms, support or resistance levels, these are all suitable reasons to sell a credit spread, because this is really when you don't expect the stock to make a substantial move higher or lower, or you have a level that you know that the stock is likely going to stay above or below. That's when you want to sell that credit spread. And again, do not use this when you're expecting a large or fast move, only for when you have more of a mild, slow expectation for that stock. Does that make sense? Please type 6 into the chat window if this makes sense to you. Okay, perfect. And one thing I just want to say, for those of you that are familiar with volatility, right? One of the things that you'll notice is that when stocks fall, volatility increases. When stocks rally, volatility decreases. It's important to understand that when you're selling a credit spread, you are technically short vega. So you're short volatility when you're selling these types of credit spreads. Now, what does short volatility mean? That means that you will generally benefit when volatility decreases. So we know that when does volatility decrease? When markets rally. Volatility increases when markets decline. So one of the things that's important to learn from this is the fact that put credit spreads have a slight edge over call credit spreads, because when you're selling a put credit spread when things are oversold, so you generally want to enter a put credit spread after the stock has bottomed and you think that the stock is now going to reverse higher. So during this time, this is when volatility is highest, and then when the market rallies subsequently, volatility will lower. So because you're short volatility, you want volatility to decrease. So that's why whenever you're selling a put credit spread, you have a slight edge because you have vega or volatility working in your favor. Vice versa, when you're selling a call credit spread, you're generally selling it near a market top. That's when volatility is lowest. So when you do get that reversal lower and the markets start to turn lower, guess what? Volatility starts to pick up, and that works against you on a call credit spread. So be careful, or just think about that next time. And in addition to that, one other thing I want to point out is that markets move up roughly 55% of the time and move down roughly 45% of the time. So not only do you have probability edge on a put credit spread, you also just have a pure directional edge as well. Even if you have no clue as far as when to pick stocks and when they're going to go higher. Just from a pure probability perspective, you have a higher probability of a stock moving higher than for a stock to move lower. So for all those reasons, generally speaking, whenever you're selling credit spreads, you generally may want to gravitate towards selling puts versus calls more often. Not saying you can't sell calls. We certainly have been doing it very selectively, like on the daily plays. We sold Schwab and Texas Instruments, both ended up being fairly well, but we generally want to do them very selectively. We generally want to sell put credit spreads far more often than we do selling call credit spreads. So one of the things that's really important to understand when you're selling a credit spread is the fact that there are two things at play. There's probability and there's risk to reward. I tend to get a lot of questions from viewers as to how do I find high probability trades? Because on the surface, who doesn't want high probability trades, right? Obviously, we want to win 80% of the time, 90% of the time, 95% of the time. But if you ask that question, what you're really missing is the other half of the equation, which is risk to reward, because the two are on a seesaw. They're counterbalanced. You can't have a trade with really good probability and really good risk reward. It doesn't work that way. When something has very high probability, what that means is that you have very poor risk reward. And if you have good risk reward, that means you're going to have poor probability. You can't have both. So it's important to understand which one do you prefer, or more importantly, how well balanced are the two. So whenever we trade options, we don't just look at probability. We certainly don't just look at risk reward. We look at how well balanced they are. So one of the things that when you're selling credit spreads, you generally will find that when you sell credit spreads near the money, like the ones that we just explained, you're going to roughly have about 67% probability of profit, and you're generally risking $200 for every $100 in reward that you're collecting. Conversely, you can sell credit spreads that have very high percentage of winners, but many times what you're doing is you're risking substantially more capital for the same unit of potential reward. And many times this type of strategy does not make sense, even though on the surface, who wouldn't rather have 90% winners rather than 67% winners? But what you'll see is that many of these will have risk rewards that are far worse than you would expect. So at 90% winners, right, the risk reward ratio many times can be something like 15-1, which means that I can win 9 times, I can win 100 times that $100, which gives me a $900 profit, which sounds great. And then you have that one loser that loses $1,500, and guess what? What's your net after all of this? Is you've lost money. So just seeking high probability trades rarely works out for you in the long run. Might work out for you in the short run because you feel like, hey, I'm winning a lot. But guess what? In the long run, you're likely going to get your account blown up. So be very careful trying to seek just high probability trades. And I'm mentioning this because I get questions about this every single day. And I want to make sure everyone understands this concept that probability and risk reward sit on opposite ends. You can't have both. And if you only look at one, you're likely missing the other half of the picture. So please type 7 into the chat window if that makes sense to you. Okay, perfect. I see a lot of 7s. So what is the optimal credit spread? Now that we've talked about all of these things, we've talked about when should you use it, how should you use it, what a credit spread consists of, what is the optimal credit spread? So we've backtested this across every single possible expiration date, different strike prices, different buy strike prices, different sell strike prices. And what we generally find is the optimal credit spread is roughly about 4 to 6 weeks out. So for those of you that came to our education event last week where we talked about optimal expiration dates and strike prices, we're following the same rules there. What we're doing is we're selling roughly 4 to 6 weeks out for a credit spread, shorter dated options because we want to maximize theta. And we were going to sell the 50 delta, the at the money call or put. We always want to sell the at the monies because our max reward here is limited. We want to maximize the max reward because on a $6 wide credit spread, we want to collect as much as possible. The only way to do that is by selling an at the money call or put. Now, again, when you sell an at the money call or put, you're taking on unlimited risk. So what you want to do is you want to buy back a lower put. So we generally find that when you buy back the 25 delta, that's when you're going to be able to see roughly 1/3 of the width of the credit spread. So 1/3 is usually the minimum that you're shooting for. Anything less than a third, then your odds are really stacked against you. So you generally want to seek at least 1/3 of the width as possible, if possible. And what that will generally provide is about 67% of your trades will be winners, and you'll generally see a risk reward of about 2 to 1 on these types of trades. So that's the type of credit spreads that you're generally going to be seeking. But like I said, there are many times where you might be able to find a credit spread using these types of spreads where you're collecting more than 33%. So the minimum rule is 33%. But generally speaking, what you're trying to shoot for is roughly closer to 40%. If you've noticed, on the daily plays, all of the credit spreads that we sell are much closer to that 40% range, usually in the 38 to 40% range, because we're trying to put our odds in our favor. When you're risking when you're collecting 33% of the width, that means you're risking 67% of the width. When you're collecting 40% of the width, then you're only risking 60% of the width. For every 1 percentage point you're able to increase this by, you're decreasing that at the same time. And that's how you put an edge in your favor. So that makes sense. Please type 8 into the chat window if that makes sense to you. Why it's so important that when you're selling credit spreads, you try to find that edge. And that edge is in the percentage of income that you're receiving for the vertical width, which is the whole premium or the whole amount that you're playing with. Okay, perfect. I see a lot of 8s. So let's talk a little bit about managing these credit spreads. Entering them, we've kind of discussed them. There's quite a few different ways, but generally speaking, you want to time them with some type of top or bottom, whether you're using support or resistance levels or technical indicators to determine overbought or oversold. You generally want to time them when you have the expectation that the market is near some kind of top, and you have a fairly strong view as far as how far the stock can go. Because if you get a breakout, let's say you have a stock that's breaking down, right? Let's say you have a support level and the stock breaks down below that support level. That might be a better time to be buying put options as opposed to selling a call credit spread. A call credit spread is much better when you're near a top and you think this market is going to roll over, okay? So entering credit spreads, I think fairly straightforward. Managing credit spreads, this is where it gets a little bit dicier because there are so many different credit spreads that you can sell. If you sell the types of credit spreads that we're suggesting here, the rules are fairly simple, but unfortunately, people sell different types of credit spreads. I see people selling all different types of credit spreads, very high probability credit spreads, really poor risk reward ratios. So we want to talk a little bit about how to manage those. Number one, the rule of thumb is that you generally want to sell a credit spread with the intention of letting it expire worthless. So in the SPY example, when I'm selling a 295 call spread, I want the SPY stock to decline, and then what I do is that call spread will expire worthless, and I keep the $6 on the $12 wide credit spread. I want it to expire worthless, so I keep all of the income. Now, that may not always happen, and sometimes what happens is you get a move down that happens a little quicker than you had actually expected. So when that happens, generally what you want to do is you want to take profit early if you can collect 50% of the gains with more than half the time left to expiration. So in the SPY example, we traded something that was 30 days away and we collected $6 in income. So if you find yourself where you've collected a $3 profit on that trade and you have more than 15 days left to go, that is an example of when you might want to start taking profits on a trade. Many times, if you get a strong directional view, you will find that this will happen probably at least half of the trades that you make, where you have a directional view, the stock makes that directional view, and you're able to take profit early. There's no shame in taking early in this type of trade, because what you really don't want to do is have the stock then rocket back higher, and now you've risked substantially more money than the income that you receive. So whenever you can collect more than 50% of the income, start taking profits, especially if you still have plenty of time left to go. Now, if let's say you made $3 profit and there's still only 3 days left to go, then try to let it expire. This strategy is only for if you have at least half the time left to expiration. Does that make sense, everyone? Please type 9 into the chat window if that makes sense as to when you want to take profits early. Now, cutting losses, this is a little trickier because it depends on how much credit that you're receiving. So before we said that you will want to generally collect at least 1/3 of the width. So if you follow those types of rules, the general rule of thumb is that when you've lost 75 to 100% of the gains of the income, that's when you want to start cutting losses. So in this particular case, if let's say I'm collecting $6 on the $12 wide credit spread, once I lose about $4.50 on that, I want to start cutting losses on that particular trade. In this particular case, this is a rare example where I'm collecting 50% of the width, so I can't really lose more than 100% of the income that I receive. But most of the time, you're able to lose twice as much as the income that you receive. So as long as you lose one time of the 100% of the income that you received, it's time to cut your losses on that trade. Now, for those of you that are selling really far out of the money credit spreads. Now, many of you that sell, credit spreads where you're only collecting maybe 1/10 of the vertical width, or maybe even 1/15 of the vertical width. That's really where you have to be extremely sensitive as to when you want to cut losses. But you have to give yourself a much wider gap here. We usually tend to find that 100 to 200% of the width is when you want to start collecting, cutting your losses here. So I see that one person saying they're not very clear. Let me just try to make this, a little bit more clear. Let's say we have a $10 wide credit spread, and let's say I'm collecting $4 on that credit spread. So I'm collecting $4 of potential income. My max risk here is $6. No matter what happens, that's the most I can risk. So here I'm collecting more than 1/5 of the vertical width, right? Because I'm collecting 2/5 of the vertical width. So in this particular case, what I want to do is when my $4 income that I receive gets to about $7 to $8, so normally I can collect $4 for this credit spread, but if a trade goes against me, I'll be able to collect more. So meaning it costs me more to buy back or get out of this trade. So when the $4 wide credit spread gets to about $7 to $8, which is 75 to 100% of the $4 width, that's when it's time to cut losses. You don't want to let it go all the way to 10, which is your max loss, because if it costs you $10 to buy back, then you've lost the $6. Okay, so that's how we do the math there. So that's what I wanted to cover with you guys here on the credit spreads. I hope that this was a comprehensive view into how to utilize the credit spreads, or how to utilize credit spreads. But I do have a couple of examples to show you before we open this up for Q&A. I want to show you a couple of things. I want to show you, number one, again, how to find and utilize OptionsPlay to analyze your credit spreads. But I also want to show you something that we are working on that we're going to be publishing in the next week or two, where we're basically trying to find credit spreads that have the best maximize the income that you receive with respect to the vertical width. And I'm just going to pull two examples here that are already pre-screened for you. This report was updated around 3:30 p.m., so right before the close, where Procter & Gamble, we found a credit spread that was a $5 wide credit spread. Procter & Gamble at the time was around $12.74. We sold the 113 and bought the 118, which is a $5 wide credit spread. But for this credit spread, we collected $1.96, which is 39% of the width. Now, there are other things that we have to do on top of this to say, well, are we bearish on Procter & Gamble? So I did do some pre-screening already and took a look at Procter & Gamble. I quite like this as a short, but I also want to take a look at Snapchat, where we found a bullish credit spread. So at the time, Snapchat was trading at $18. We sold the 17.5, bought the 16 puts. That is $1.50 wide. So a $1.50 wide credit spread, we're collecting 58 cents. This is also 39% of the vertical width. So these are credit spreads that we found that provide an edge, which is a little more than a third, because whenever we collect more than a third, we're reducing our risk at the same time. And the reason I want to point out these two out for you guys was because the IV rank on the Procter & Gamble was 15%, and the IV rank on Snapchat is 18%. Normally, these would be considered a big no-no for selling credit spreads. You'd be looking at buying debit spreads. But here's an example of a credit spread providing substantially better results than even though volatility is low. So don't just always use volatility to determine which type of spread that you trade. You really have to look at the two. And I'll just pull this up for you real quick. I don't have quite enough time to go through each one in a large amount of detail, but Procter & Gamble, relatively neutral, 6-month trend, 1-month trend turned bearish over the last couple of days. It's still sitting near the bottom of the range. Maybe it breaks lower, but here's where we can take a look at this trade. So we were looking at a short call vertical. I said we were selling the 113, 118. So it looks like Procter & Gamble sold off a little bit into the close here. So $5 wide credit spread, I'm collecting $1.85. So $1.85 divided by 500 is 37%. But like I said, Procter & Gamble moves substantially lower. So I would probably maybe sell the 112, 117s, which as you can see now is $2.08. So it's actually a little bit more. 208 divided by 500 is 41% of the width, almost 42% of the width. So if you're bearish on Procter & Gamble, here's a credit spread that provides quite a bit of an edge, because normally we're collecting 33%. Here I'm collecting almost 42%. So this is really what this credit spread report is designed to do, is to find these cases where we're able to gain an edge and then overlay our directional view on top of that. And Snapchat, I'll take a look at that real quick. Whoops. Snapchat is a very strong stock. 1-month and 6-month trend is bullish. This is a stock that we've been quite bullish on. So it's trading at 17.55. We were selling the 17.5, 16 here. So let's take a look at that real quick. 17.5, 16, which here collects 70 cents. Now, these are after hour bid ask prices, so I'd be a little careful here. I don't think that you're actually going to be able to collect 70 cents. It'll probably close to maybe 65 cents or so, but so let's just see, 65 cents off of $1.50 is 43% of the width. So this is really where, again, what we're trying to do here is not just only find directional views, but also find where we have an edge. This is how we've been finding a lot of the credit spreads that we've been selling over the last month, as things were fairly, as volatility was relatively high, and we didn't have a strong directional view because we felt that the markets were fairly priced. And that's why we've had this market kind of battle around 285. We haven't seen huge gains or huge losses in the market. So these are ideal conditions to sell credit spreads. I will say volatility is starting to come down a little. It's getting to the point where you're not getting as much premium, and we're starting to get more of a directional bullish view on the markets. So it might be that credit spread time, selling credit spreads right now is not the ideal conditions, but it's yet to see, because we could get a pullback. VIX can get back above 30 in the next couple of days, and maybe it's back to selling credit spreads again. So these are some of the things that we discuss every single Friday morning, Tuesday and Friday morning during our 9 a.m. session. So I really hope that many of you are able to join us for that, because we will actually take a lot of these things that we're teaching you here on Thursday afternoons and applying it and showing you some real symbols and real markets to apply them for those. So with that, I want to thank her for taking the time out here this afternoon. I wanted to give you guys a sneak peek at some of the things we're working on. We're hoping to publish this credit spread report over the next couple of weeks here. And we'll definitely make sure that everyone is aware of that and send you guys an email to let you know that these reports are being distributed. It will be the same thing as the bottom, how we've added the liquidity and earnings link. You'll get the credit spread report down here at the bottom when we do add that. But this was meant as a training session to help you guys better understand how you want to sell, how you want to utilize credit spreads, and more importantly, know when to use it and when not to use it. Don't just constantly sell credit spreads, and certainly don't do it when just because volatility is high, and don't avoid selling credit spreads just because volatility is low, because we've seen plenty of examples where you shouldn't sell credit spreads even though volatility is high, and we see plenty of examples where you can sell credit spreads and gain quite a bit of an edge even when volatility is low. So with that, I want to thank everyone for taking the time out here this afternoon. Just a quick couple of housekeeping items before we move on to questions here. I hope that for those of you that enjoyed this session and learned something, you're able to support us and become a member, which you can do using just the link here on your screen. just $75 a month or $500 a year. You can sign up using that link, especially if you're past your free trial. This allows us to continue working on our platform, building out credit spread reports, continuing this education, and provide this type of market outlook and research for you every single Tuesday and Friday morning. And for those of you that want to join us for that, you can sign up using this link as well. For those of you that have not joined us on Tuesday and Friday morning, it is a very different session. We don't do any education. We just talk about where the markets are trading. We look at what research we're looking at. We look at what symbols are making some big moves, so that Procter & Gamble and Snapchat would be an example of something that we would bring up on Friday morning right before the open, so that you have some ideas going into your Tuesday and Friday morning sessions. So with that, again, thank you so much, everyone, for taking the time out here this afternoon. What I will do is I will open this up for Q&A. Now, there's a chat window and there's a Q&A window. If you don't mind, please type your questions into the Q&A window. This way, it's a little easier for me to manage. Unfortunately, there's too many things in the chat window for me to take a look at. So please, if you have a question, please type them into the Q&A window and I will answer it from there, okay? And also, one of the things I want to ask is, we want to take more of an approach where we ask you for what you want to hear from us next. I want to produce a lot more short videos, because as great as these long format webinar education sessions are great for teaching you, in-depth education for options education, sometimes you just need a quick video. So what we're trying to do is understand, what do you guys want to learn? So please, at the end, before you sign out here today, just write into the chat window what kind of topics you want to learn from us, whether it's a short video or perhaps longer format webinar. Just type them into the chat window. We'll go through them after we finish here today, and we'll use that to inform our decisions to know what type of short videos we'll be producing for you, because I know many of you love watching these long format webinars, but sometimes we don't have enough time and you want to just learn something quickly in maybe 5 or 10 minutes, and we want to produce some of those more. So please, before you leave, type into the chat window what topics you want us to cover, and we'll make sure we prioritize that. So let's go ahead and take a look at the questions here. I have quite a bit of questions. I have a newbie question. I sold a $40 put for $1.60 credit. When do I lose money? You lose money if the stock goes below $1.60, below $40. So you lose money at about $38.40 or so. Anything below $38.40 is when you'll start losing money on that trade. When do I cut losses on my naked put? I would argue that you should never sell a naked put on a stock that you don't want to own. You should only sell a naked put on a stock that you actually want to own. So you usually don't cut losses, because the worst thing that happens is that you own the stock that you want to own. Why do you rarely adjust your spreads? So Jock, that comes down to my philosophy as far as trading goes. A lot of people try to adjust spreads to try to prevent themselves from losing. If you watch the part 1 of our intermediate options trading course, where I talked about trading psychology, I talked about the math behind winning and losing, and just the math behind being successful as a trader, you notice that successful traders don't hang on to losers. And what they don't do is they certainly don't constantly try to correct losers into winners, because as you continuously try to adjust your position, you generally take on more risk. And what you're doing is you're constantly trying to shift your philosophy into not losing. And the second you let go of that, the second you understand that trading involves losing, and you accept your losses and take on those losses and move on to the next trade, the better you become as a trader. So that's why we rarely adjust our spreads, because at the end of the day, we were wrong on our initial analysis. That's why we lost money. We can accept the fact that we're wrong and move on to the next trade. We don't have to be right all the time. You just have to make money. You don't have to be right. You could actually be right only 20% of the time and still make money. That's the only thing that matters. Being right does not matter. Can you explain the RSI rank in the trade? I'm not sure what you mean by the RSI rank. When you get a minute, what are the blue and orange lines on your chart? That's just a simple RSI. I use a 14-period RSI, and I use a 9-period moving average on that RSI. I'm predominantly, I use RSI. That's my main indicator. I don't get fancy. I spent 7 years at a currency trading firm, which means that a lot of currency traders use technical analysis. As a strategist, I've seen just about every single chart under the sun. I've seen people with thousands of indicators on their charts. I keep it simple these days. RSI, couple of moving averages, that's it. Tony, when you sell a put option in this case, is that what you call a short? Yes, we call that a short put. What if you buy a put at 142 and buy a call at 149? If you buy a put at 142 and then you buy a call at 149, that would be a strangle. So you're buying a strangle there. You can do that, but I certainly don't recommend it, because you're basically saying, I think the stock's going to make a big move to the upside or a big move to the downside, and you're really paying through the nose, and you have time decay on both sides, and it's very difficult to make money in that scenario. Isn't that risk with selling put leg is somewhat mitigated by the exercise and end up owning the stock? It is true, but most of the time when we're talking about these types of strategies, you don't really want to own the stock. That's why we're looking at these types of strategies. In this case, is $350 cash held as security. So in a credit spread, okay, good question. So in a credit spread, whatever your max risk is, that's going to be your margin requirement. You need to hold the $6 to sell this credit spread. If you sold just a put, you're going to need $29,000 to sell that put. Here, when you sell a credit spread, this is another reason why people like selling credit spreads instead of naked puts or cash secured puts, is because the margin requirement is significantly lower. Please explain break even on a credit spread. It's the same as any other strategy. You're just your break even here in this particular case is $295 plus $6. So your break even here is $301. So $295 plus the $6 credit, that's your break even price. How much cash is tied into that strategy? I think I just answered that. Is this webinar recorded? Yes. Other experts like to say nobody knows anything, so your view in the market direction should not play a part in your decision, only the amount of credit you get with a high pop. Well, Ron, sure. And I think, you know, if you talk to someone like Tom Sosnoff, that's their general thesis and view on the markets. I'm not a believer that you have no directional view. I certainly have directional views. I don't know anyone that truly says that they don't have a directional view, even if they want to. But that's part of why we created the credit spread. The credit spread trade file doesn't have a directional view. It just tries to find you the best possible credit. We do try to overlay our trend indicators on top of it. That's what we're finally working on before we publish this. But we do want to give you some directional view. Especially parameters that we know for a fact have some predictive power of future returns. As a general rule of thumb, what is the premium cost to stock price? Wayne, I've never thought about that in terms of the stock price. I'll have to get back to you on that, but we generally don't think of it as a stock price, because the only thing that matters is the width of the vertical. It doesn't matter if you're trading a $5 wide credit spread on a $300 stock or a $5 wide credit spread on a $100 stock. Your maximum risk is $5. So that's why we generally don't think of it in terms of percentage of the stock price. Can we find credit spread ideas in the platform? Satish, as I just showed you, that credit spread file, that's what we're working on. That's exactly what we're going to publish, so you have those ideas. In your SPY example, if the price of SPY goes through your short strike and the buyer of the call exercises the option, you might be responsible for dividend if it happens around X dividend date. Great question. And I think I want to answer this more so in the context of what happens when you sell a credit spread and you get assigned. I certainly think dividend risk is there. I wouldn't say you're responsible for the dividend per se. I guess you're saying that if you're short the stock that you have to pay the dividend. Yes. But generally speaking, that's not a huge portion of your risk on a trade. So one of the things is that, let's say you sell this 295.307 call spread on SPY, right? Whoops. Let's say you sell this 295.307 call spread on SPY. And let's say the stock rockets higher. Let's say it goes to 310. This short 295 call is at risk of assignment. And that many times scares people because you're all of a sudden your credit spread, now you have a short stock position. One thing I will say is that the the early exercise of a credit spread is actually works in your favor because the person who exercised early is giving up the extrinsic value that you just now gained. So when you have an exercise, when you have a credit spread that's exercised early, the best thing to do is actually close out that trade immediately. Because number one thing to remember is that even if you don't close out that the stock leg immediately, your risk doesn't change. You're just switching a short call for a short stock position or a short put for a long stock position, but your risk still remains the same. So number one, when you get assigned, don't freak out. Your risk doesn't change. Number two, it actually works in your favor because the person who exercised gave up the extrinsic value that you now gained. So what you can do is you can close out your position and just close out both legs as soon as you see some type of assignment. Now, I will say that I've seen varying degrees of assignment based on broker. It does seem that some brokers assign short positions to people more often than others. I will say that as a credit spread seller myself, I have rarely been assigned. But maybe that's partially because I'm fairly diligent in managing my positions. But also, I do think that TD Ameritrade, in my opinion, the broker that I trade with, I don't know, does not seem to assign assignments to me very often. Maybe that's just me. I don't know if anyone else has a different experience. Yes, we will send out the recording afterwards. How do I subscribe to the OptionsPlay service unable to log in? So if you have an issue with logging in, you can send me an email at info@optionsplay.com. But you can always become a subscriber using the link here on your screen, which I just posted into the chat window. Randall saying, Tony, do you ever sell in the money credit spreads? No, because in the money credit spreads have a much higher risk of early assignment. So generally speaking, whenever you're selling a credit spread, you don't want to be assigned early. So when you sell an in the money credit spread, yes, you are, well, keep in mind that when you're selling an in the money credit spread, you need a much stronger directional view. You can't just have this mild directional view on that trade. So that's why we never sell in the money. It increases your probability of assignment and it turns it into from a neutral directional view to a directional view. If the day before expiration, you have a limited percentage of the full gain, is it better to close the trade or just let it expire? So I guess that depends on how close you are to the strike price, because at the money options that are close to expiration have a high amount of gamma risk. So meaning you can turn, the position can turn into a full winner or full loser within just a few pennies of a move. So your gamma risk is extremely high. So generally speaking, when you're near expiration and you're profitable, you generally want to cut your losses. Unless you're really far out of the money and you're fairly confident that it's going to expire out of the money, then you can let it expire worthless. Where is this report on credit spreads, Laura? This is not published yet. We are working on publishing that in the next week. Does open interest also important as weekly expiry have low open interest? So let me address this open interest question, because I've been getting a lot of questions about this, and I will say it's one of the questions that I've been consistently getting for years. But open, I tend to get the feeling that most people seem what's the right word? Seem hesitant to pull the trigger on an option strategy where they see that there's low open interest. Now, one of the things I want to tell you is that that is no longer true. That just doesn't apply anymore and it hasn't applied for years as electronic market making and exchanges has increased the number of strikes available for trading from a few 100,000 to 1 million plus. You naturally will just have lower open interest per strike because they're listing so many strikes. They certainly did not list Apple strikes from $5 to $1,500 even 5 years ago. So The low open interest is simply just because they're listing a lot of strikes, and they're listing a lot of strikes because market makers are fully electronic. They can now, market makers make a market across a million option series. So in the world, in the day of electronic market making, low open interest does not mean anything. If you have a bid ask spread that's not that wide, you can interact with the quote. Don't be afraid to interact with the quote. Don't let low open interest stop you from trading. We only send out alerts on options that we know for a fact are liquid, and that I, for example, will never place an options order outside of the mid price. Every single options order that I place is usually at the midpoint, and I either get filled or I don't. That's it. So I'm not really paying anything in terms of transaction costs from a bid ask spread perspective. And anything that we're sending out is, generally speaking, already past a liquidity test. But we also produce this liquidity report for you so that you can see which symbols have low bid ask spreads. Doesn't matter what open interest is. Open interest is now just a function of how many strikes that are listed, and they're just listing more and more strikes because electronic market makers can now make markets across a million strikes. Before, back in the day, when a guy sits on the floor, they can only list so many strikes because a guy can only hold so many on his notebook in his hand. So forget open interest. That was a thing of the past. Don't let that stop you from trading. Weekly options are just as liquid as monthly options, even though they have lower open interest. They just haven't been around for so long. That's why they have lower open interest. Don't let that stop you from trading a trade. Place your orders at your mid price. If you get filled, great. If they don't get filled, then maybe the thing wasn't as liquid as you thought it was. If I've been into covered leaps for about a month and I wanted to add more contracts, would I close the trade and roll it forward, or open another trade with more contracts in it? Roger, I'm not exactly sure what you mean. You obviously can only cover a certain number of contracts, so it depends on whether or not you can cover those contracts. Unlimited profit or loss seems a little bit misleading. I completely agree with you, but that's technically what's true. What is IV rank and how do we apply it? IV rank is really just telling you where volatility is compared to the last year. So let's say the lowest SPY has ever been in terms of implied volatility is 10, and let's say the high it's ever been is, let's say, 30. So let's say that's a range of 20 points, right? So your IV rank range, or I'm sorry, IV range is about 20%. So if today the IV implied volatility of SPY is at 20, what that translates to is an IV rank of 50%. Now, if let's say today's reading is 25, then that's an IV rank of 75%, which is 75% of the range. If today IV is at 15, then it's at 25. So it's really just telling you where the current IV is in relation to the maximum and the minimum from this past 52 weeks. So that's how you measure IV rank. How do you handle when the stock price is below the sold put and above the bought put? I don't know that. What do you mean by handle it? There's not much to handle. You either decide that it's time to cut your losses in this particular trade, which we gave you some of the rules as far as when you want to cut your losses, or you want to hold on to it because you think the stock's going to come back. I don't know that there's any particular rules as far as handling when it's in between per se. Could you explain the spreadsheet analysis of Procter & Gamble versus NVIDIA? Is there a reason it's not a good credit spread? I don't think NVIDIA is not a good credit spread. I didn't suggest that for a second. This very well could be a good credit spread. I just didn't look at NVIDIA. NVIDIA just posted earnings yesterday, so I didn't want to look at something that just had earnings yesterday. That's why I didn't take a look at it. Please go over theta and vega. So your short theta and your short vega in a credit spread, just like that short put, your short volatility and you're also short time decay. Thanks for the session. I should have done a credit spread, not naked put. Well, so naked puts are useful in many other cases where you want to own the stock, right? So if you want to own the stock, don't sell a credit spread, just sell the naked put. What's your view on GDXJ? I'm generally speaking bullish on the miners. I know the miners pulled back a little today. I actually think that might be a good time to sell a put credit spread if you still believe that gold is going to continue to rally. GDX, and GDXJ both passed. Have been pretty high on the list in terms of credit spreads over the last few weeks. So but that's my personal opinion, and we do talk about that a little bit more on Friday morning. So please join us on Friday morning if you're looking for some of those directional views. What do you think about a risk reversal on BDX? I haven't looked at BDS, and I certainly haven't looked at risk reversals. So if you want me to look at that, send me an email at info@optionsplay.com. Overall, what's the difference between spreads that have a narrow and a large spread? I'm not sure what you mean by the difference between spreads that have a narrow and large spread. I guess if you mean if the strike prices are close to each other. So for example, if let's use a stock with a higher stock price like 146. If we look at Johnson & Johnson, yes, you can sell a 146, 140 put spread, right? As we were talking before, 146, 140, which is a $6 wide credit spread. You can also sell a $2 wide credit spread, right? You don't have to just sell a $6 wide credit spread. The difference between the two is that when you sell a credit spread that's very close to each other, the two deltas are very close to each other. So your net delta is very little. So even if Johnson & Johnson rallies, what you end up finding is that you make very little money on this particular trade because your net delta is very close to zero. That's why you want to spread it out a little. You want to have a net positive delta so that when the stock rallies, you make money. If they're too close together, you actually have a net, delta closer to zero. Do you have any research on the management of credit spreads, closing out the position, cutting losses at 75 to 100% versus holding longer? We have done this type of analysis. That's why we arrived at those numbers, Ron. We generally find that when you are at that point, you're better off cutting your losses than holding on to that trade. Kenneth is saying, can you sell a credit spread or debit spread when you don't have the stock in your portfolio? Yes, both credit and debit spreads do not require you to own the stock or short the stock or anything like that. The whole point of these vertical spreads is that you do not have to touch the stock. So regarding the mechanics outlined for exiting, these are what you recommend for the OptionsPlay signal service? Yes, Jay, that is correct. Do you also pre-screen your stock twits alerts? Yes, that is exactly what we do. What platform is this? Linda, if you're talking about OptionsPlay, it's our own platform. I will send you a link here for you to sign up for a free trial if you're interested. It's a free 30-day trial. It gives you access to everything. You can sign up using the link here at the bottom. How do we get the slides? We send the slides to you afterwards, and that's also at the bottom of the link at the YouTube recording. Bradley, regarding your question about the Memorial Day, you can send me an email at info@optionsplay.com and we can take a look at your account. How do I see the IV rank on OptionsPlay? That's something we're working on, but right now you can see the IV rank through the liquidity report as well as through the through the liquidity report right now. We have a column in our liquidity report which says IV rank. How do we get a copy of the slides? We will send it out to you afterwards, including the recording, and you'll be able to see it on the YouTube recording. Recently liked your finance vertical on HYG, was eye-opening to me. Why don't we always play finance spreads? Well, I mean, the challenge with finance spreads is that you also have to have the margin requirement, right? So HYG required a $7,500 margin requirement to sell that $75 put. So you have fairly limited gains for that $7,500 margin requirement, which is why it's not, in my opinion, my favorite strategy. But it is a strategy that allows you to start profiting on a debit vertical spread much sooner. HYG normally would have had to make, a 3-4% move just to break even on that debit spread by using a call spread risk reversal. The stock doesn't have to move as far. What are the technical and fundamental indicators you do for a review? So I'm still, I use RSI predominantly. We use RSI in a few different ways in our proprietary scanning capabilities. This is something that we do, but also we predominantly use the 1 month and 6 month trend and the technical score. We generally want to go long stocks with strong relative strength and short stocks with weak relative strength. Is Johnson & Johnson recommendation for tomorrow? No, I don't believe so. That was just an example. That is not going to be our daily play. How do you scan for the best candidates to increase probability of keeping credit? Well, you have to first capture the best credit before you can keep the best credit. So that's the first and foremost. Second, you generally want to have the trend and relative strength on your side. So that's why we publish a trend indicator and a relative strength indicator. You want both on your side for trading. How volatility impacts call credit spreads. So I think we discussed that a little bit. If you have a specific example as to how you think, how you want to look at that, I'm happy to go through that. Should you promote your Jay? I will say that the options, the stock twits service, I'm not sure it's something that we necessarily will continue for forever. So it's something that we're still deciding on at the moment. That's why we're not talking about it here. Please provide a seminar on SPY trading, especially daily trading. I will say options isn't really a day trading product. If you want to day trade SPY or the S&P 500, you're much better off trading futures. What would be some of the obstacles to writing spreads as a living? What would be some of the obstacles to writing spreads for a living? I don't know that there's an obstacle per se. You just have to constantly try to find credit spreads that give you an edge, and then overlay that with a directional view that you also feel is a reliable way to gaining that directional view. If you can marry those two together, you can have a very successful living selling credit spreads. I certainly know a lot of people that do. Is there a point on taking any of these positions that you need to cover with purchasing the actual stock when considering risk? So again, all of these positions do not require you to own the stock or cover with stock or anything like that. That's the whole point of credit and debit spreads. Please also discuss debit and calendar spreads. So we actually have a whole separate session on debit spreads. I could add one on calendar spreads, so thank you for that feedback. How do I learn how to trade options on high momentum stocks? I'm not sure that trading options on high momentum stocks is any different than trading stocks on low momentum stocks. You're just trading something that has more risk. That's it. But the trading is still the same. Both the legs should be closed together or only short one? Both legs should be closed together on debit and credit spreads. When you take 50% quickly, what's the risk reward over 100 trades of credit spreads? What's the risk to reward over 100 trades with credit spreads? Not sure I understand your question, Bruce. If you don't mind clarifying, I'm happy to answer that question. Would it be great to see how you evaluate particular tickers? So if you want to see me evaluate particular tickers, please come Tuesday and Friday morning. That's exactly what we do for half an hour. I look at the market, I look at sectors, I look at individual names, and I even point out what option strategies we think are suitable for the current market environment. So we talked heavily about credit spreads over the last month. On Tuesday, I talked about starting to think about buying some debit spreads. That's why we tiptoed into Tractor Supply last night using a debit spread. So because volatility is coming down, it makes more sense many times to buy premium now. Is learning how to read charts important to trading options? Well, learning the directional view of a stock is important to trading options. You don't necessarily have to use charts to gain that directional view. You can use statistics, you can use fundamentals. I happen to use charts. Many people happen to use charts, but it's not the only way to gain a directional view. When will you have real-time stock quotes? It's something that we're currently working on right now. Do you recommend selling credit spreads by rolling the month, assuming we're confident in the direction of the market? Yes, but I will say, Jason, that you should probably close the profitable credit spread and open a brand new one. You may not necessarily time the two together because you want to, whenever the optimal time to close a credit spread is usually not the optimal time to open a credit spread because, for example, if you sell a put credit spread, you want to close it when it kind of has that nice rally. That's not the best time to open that credit spread. You want it to fall back down before you sell another one. So that's why, generally speaking, you don't roll them. You might close them and then open a new one maybe a few days later. How do you repair or adjust spread that's losing? My suggestion, close out the losing trade, open a new one if you have to. Don't try to repair because repair requires more risk. And what you're simply doing is adding more risk to a losing trade, and you're trying to throw good money after bad money. Learn to take a loss. Learn to accept the fact that losing is part of trading. You will become a far better trader when you learn how to take losses and move on and not let them bother you to the point where you're throwing good money after bad money. Webinar for when to unwind an options trade. So I think we cover that predominantly in each strategy. Within each strategy, we talk about when it's time to unwind. Earnings play, well, earnings season is pretty much over. We do earnings plays usually the second or third week going into a new quarter. So every single quarter, we always do an earnings event, but it's always second or third week into the quarter. We already had about 95% of S&P's names report earnings, so it's really not the best time to look at earnings. What is the status of the Macy's trade? It's still on. I mean, that butterfly, I have my order set to try to take profit on that. I will alert you as soon as that something like that is able to get filled. I still like the trade. You know, the stock hasn't moved very much. It's still around the entry price. Macy's certainly does not look good. I still don't like the stock, so I'm holding on to this trade for now. I've noticed that sometimes the bid-ask and credit spreads is very wide. So I guess it depends on what names you're looking at. We will only scan for liquid names for our credit spreads. Yes, sometimes they'll be wide, but I'll generally find that I'm able to get filled at the midpoint. If you own Tesla stock here, would you sell cover calls against it? Absolutely. I think selling cover calls when markets are this stretched from a valuations perspective makes a lot of sense, especially when volatility is still fairly elevated, which it is for Tesla. How do I understand what this means to me, profit or loss? Gene, I'm not sure if you could clarify. How do you choose deltas on bull and bear verticals? Oh, that's a short video topic. Okay. Thank you so much. I will consider that. What plans for growth do you have on your platform beyond credit spread report? So we're working on debit spread reports. We're working on straddle reports. We're working on a lot of different things. You know, and also if you guys have some suggestions, feel free to email us and let me know. Is there a percentage gain you automatically take regardless of expiration date? Is there a percentage gain you automatically take regardless of expiration date? Not really. I would say it's always heavily, with these types of strategies, you always have to look at gain and the amount of time left to expiration. What strategy is preferred before earnings? Selling put credit spread or buying? Selling the put credit spread or buying the credit call spread? I think you mean buying the debit call spread. Haresh, that depends on how far you think the stock's going to move. If you think the stock's going to make a big move, as we learned today, you should buy the call. If you think it's not going to make a big move, you should sell the put. That's what we did in Target, is because we didn't expect Target to make a big move. That's why we sold the put credit spread instead of buying that call debit spread. What does POP mean within trading strategies? It just simply means the probability of profit. I took 5-year recommended daily plays, all made money, did one of my own, got crushed. I think that was just pure coincidence, Artie. Don't be too discouraged. Feel free to continue to experiment on your own. Keep getting error that my email's not verified. Mark, if you don't mind, send me an email at info@optionsplay.com and let me know with your email address, and we can certainly enable your account for you. Michael, I'm guessing that was a suggestion for the short video. Would it be possible to manually adjust the bid-ask or debit credit price for strategies to calculate and simulate a P&L scenario? That is actually something that we are actively working on. We have a new feature called Save Trade, which allows you to save a trade to a portfolio, which also allows you to customize your price on that trade. So that is something we are going to be launching here in about a month. What is the biggest advantage of debit spreads over covered leaps? I don't think the two are really comparative. You know, a debit spread is when you have a strong directional view. A covered leap is for taking a long-term bullish, short-term neutral view on a stock. So not sure that you would really compare the two. Can you please do an iron condor webinar? Actually, great question. Iron condors. So a credit spread, you know, when you marry the call credit spread and the put credit spread, that is your iron condor. The reason that we rarely trade iron condors is because iron condors basically is saying that I'm bullish and bearish at the same time. And generally speaking, I always have some directional view. I'm never going to say that I think the stock is going to stay in this, I think the stock is going to stay put. So that's why we generally don't use iron condors. You can leg into an iron condor. So for example, you could, for example, let's say today, let's say today you sold a call credit spread on SPY, and 2 days later, SPY breaks down to 284, and you think, let's say today you sell a call credit spread on SPY, and SPY pulls back to 284. What you could do is you could sell a put credit spread then, and what this combination creates is that iron condor, but I wouldn't enter this and this at the same time, because the best time to enter that call side is when it's overbought, and the best time to enter that put spread is when it's oversold. A stock can't be oversold and overbought at the same time. So that's why, generally speaking, we don't trade iron condors. You can leg into an iron condor, but we don't trade an iron condor as an individual strategy. If you can give me a different reason as to why I should look at selling iron condors, I'm happy to take a look at it. But from my perspective, I don't find an edge in selling iron condors, in my opinion. You mentioned selling puts for income at a delta of 0.4. That increases the chance of buying stock much higher. Don't we want it to expire worthless? Not if you're selling a put because you want to own the stock. If you're selling a put because you want to own the stock, you don't want it to expire worthless, or else you're not going to participate when the stock rallies. So you want to own the stock. That's why we sell a longer dated option. What's your overall opinion on selling credit spreads with 0 days to expiration? It's what we call picking up pennies in front of a freight train. You can do it. You're not going to collect much premium, and you're generally going to find that you're going to be much closer to the at the monies than you actually would really like to. And you just need a few bad weeks, and you're going to blow up what you gained the past 3-4 weeks. Nothing wrong with that. If that's the type of strategies that you're comfortable with, and that's the type of risk reward you're comfortable, by all means. Not my kind of thing. That's my take. What are those MAs on your chart? It's just 20-day exponential moving average. So regarding exit mechanics, what are, yes, Jay, I think I answered your question before. The trend indicators, the 1 month and 6 month trends, what are they based on? They are based on short, medium, and long-term moving averages, 20, 50, and 200-day moving averages. Repeat question in case earlier attempt not seen. If day before expiration, you have limited percentage of full gain. I think I've already answered that question. If stock falls, then volatility falls? No, if stock falls, volatility increases. Is it generally a good idea to sell cover calls if you own over 100 shares in different stocks? James, I'm a big advocate of selling cover calls as much as possible, because it's a great way to gain income while you wait for your stocks that you own to rally. Let's see. Tony, you made significant positive changes already in the right of any great future and long valuable time. Thank you very much. Thank you so much. I really appreciate that. Thank you for the kind words. Is this for newbies or for more advanced traders? I certainly would say credit spreads is leaning more towards a more advanced strategy. I wouldn't tell a beginner trader to start with credit spreads, but today what I want to do is break it down so that even if you are a beginner, you understand the strategy and know what it's for, so that when you do get to that point, you're aware that this type of strategy exists. Linda, I like your style of teaching. However, it seems fast and a little over my head. Linda, I apologize for going too fast, but that is why we record these. That's why we make the slides available to you, and we send the recording to you right after, so that you can have the slides with you, you can watch the recording and do it at your own pace. Could you please send me a copy of the webinar? Yes, we will send it to everyone here. Robert, if you have a question about the StockTwits service, you can send me an email at info@optionsplay.com. I'm happy to answer your question regarding the StockTwits service. What is an acceptable bid-ask spread? So great question, Richard. We measure the bid-ask spread across multiple strikes. It's not just a single strike, because sometimes you have some strikes that are wider, some strikes that are narrower, and we always look at it as a percentage of the stock price. So we want to see that to be under roughly about 0.5% of the stock price is your bid-ask spread. But again, there's a lot of complicated computations that go into that, so it's hard for me to just summarize. What are the advantages of being a subscriber to OptionsPlay? Great question. You get access to this platform. You get access to our daily options trading ideas. So for example, we're going to be the tractor supply trade that we posted this morning. You have access to the trade. More importantly, I think the most important thing is really the fact that whenever you look at a trade idea, you don't want to just follow anyone's trade ideas blindly. That's never a recipe for success. Many times you might look at a trade, you might say, hey, you know what, this is a great trade, but I'd like something better. I don't like buying this debit spread. I want to sell a credit spread. You can use this tool to sell a credit spread instead and take a look at what selling a credit spread looks like on this particular name. You can utilize this if you disagree with us. You can click on I'm bearish and take a look at some bearish views on Tractor Supply. Really having access to this tool allows you to be self-sufficient in finding options trades, analyzing it, and trading it on your own. That's the main advantage. Everything else that we provide, the daily trade ideas, the education, the reports, this is all to support you to be able to do that work on your own. So that's why you might want to become a subscriber or a member of OptionsPlay. I think I answered the question as to what IB rank is. When is the best time to exit a profitable trade? That depends on which strategy that you're trading. If you're long a call, it's different than if you're selling a call option. So I do recommend that if you watch our previous recordings on a specific strategy, we do talk about each specific strategy and when it's time to get out. Action plays around earnings. I can certainly do a short video on that. Usman, I'm happy to give you a little bit more of the insights into that. If you can send me an email at info@optionsplay.com. Can you use the P&L simulator to find an exit point on a position that you have had for a while? Sold a credit spread 2 weeks ago at certain strikes. So, you don't necessarily need the P&L simulator for that. You just need to know what percentage of the total premium you've received. If you collected more than 50% of the profits, it's time to take your profits. Hardly. As far as getting a strike listed, I'm sorry that that's what it takes. Unfortunately, I don't have influence in terms of listing strikes, so I can't really speak to that. Will this Excel file be shared with members? Yes, this credit spread file will be shared with members. It will be a link at the bottom of your platform, just like liquidity and earnings are. Can you sell a credit spread or debit spread when you don't have the stock? Yes, you do not need to own the stock to sell a credit spread or buy a debit spread. What about the bid-ask spread? If you only put in at the mid price, how likely are you going to get filled? Great question. When you choose names under this very liquid list, very often will you get filled at the midpoint. If you start deviating from that and you start trading stuff that is somewhat liquid, you might find that it's a little bit more difficult. If you find something outside of this name that's not in this 477 names, you will find it difficult to get filled at the mid price. Rather than close a trade, isn't rolling a credit spread into a condor out the money? Not sure I understand your question, Mike. Is there an advantage of owning the stock when placing a credit spread? Not that I'm familiar with. Satish, you're very welcome. As soon as I place a debit or credit spread, I see the trade is down 10% or so. Why? You might be getting filled not at the mid price, because if you get filled at the mid price, you shouldn't see that. You should basically see a flat position. But also some brokers They price your P&L based on if you were to exit at the worst possible price. That may be why. It's hard for me to tell depending on who your broker is. Are calendar credit spreads less risky since you could adjust each leg? I don't know that it's more or less risky because you can adjust the legs of a credit spread as well. So on resistance, we selling bull put, and support we sell call. No, vice versa. Vice versa. You sell a bull put near support, and you sell a call credit spread near resistance. Okay, so I really appreciate everyone attending here today and providing your participating, providing your ideas as far as what you want me to cover in terms of short videos and webinars going forward. I tried to answer as many questions as possible. Look at that, 174 questions, and I didn't get a chance to get through all of them, but I really tried to get through as many as possible. Thank you so much for participating today. I hope that you guys find this useful for your trading, and I hope you guys consider supporting us by becoming a member. And please join us Friday morning where we're going to cover the markets. We're going to talk about where we think the markets are going to head. You know, we thought this was going to break out, hasn't really broken out quite so much, but we're going to discuss all of those things. We're going to talk about our research. We're going to talk about what symbols we're looking at for trading intraday on Friday. So please join us tomorrow morning at 9 a.m. And I hope to see you guys there. Until then, I hope you guys have a great evening. We'll send out the recording to you guys here in a few minutes. Have a great night, and I'll see you guys tomorrow morning.